Thank you, Franklin. The subcommittee will come to order. Without objection, the chair is authorized to declare a recess of the subcommittee at any time. Without objection, members of the full committee not on this subcommittee are authorized to participate in today's hearing. If you are participating today, please keep your camera on, and if you choose to attend a different remote proceeding, please turn your camera off. Members are also reminded that they are responsible for unmuting and muting themselves and to mute themselves after they are finished speaking. Consistent with the regulations related to remote proceedings, staff will only mute members and witnesses as appropriate when not recognized to avoid inadvertent background noise. Members are further reminded that all House rules relating to order and decorum apply to this remote hearing. Before I kick us off, I want to just spend a couple of minutes, since this is the maiden voyage of the National Security, International Development, and Monetary Policy Subcommittee. I am just delighted to be joined by French Hill of Arkansas as the ranking member. I consider French a good friend of many years, and there are really few members for whom I have so much respect in this institution. If you want an example of French's commitment to technical policy issues, look no further than his op-ed in yesterday's Wall Street Journal on IMF special drawing rights. I recommend you do that right before bedtime. As chairman, I've got two objectives for this committee. First, our committee needs to make progress on a wide variety of issues and conduct hard-hitting oversight, from the financing of violent extremists to the economic implications of a massive Federal Reserve balance sheet. We have a lot of work to do. I invite every single member of this subcommittee to talk to me or to French about areas that you would like to pursue. Second, and just as importantly, I'd really like to do this right. I'd like to do this in a way that honors the trust that lots of our constituents have put in us and which begins to rebuild this institution. I think as I look at the subcommittee membership, that with the exception of Mr. Lynch, I think I've been in the House longer than anyone else on the subcommittee, 12 years now. So I'm not one bit naive about the political pressures that we all face. And frankly, I've never seen it so bad. As we sit here, many of us are full of anger, suspicion, anxiety. Some of us want revenge for this or that. All of us went through something on January 6th that we never imagined would ever happen. So my second objective for this subcommittee is to show the Congress and the world that even in these days of white-hot emotion, we can make progress, model a more decent politics, and maybe even build some bridges. I've been here for a while, so let me offer just a little bit of specific guidance. First, let's be forward-looking. The presidency of Donald Trump will be scrutinized by historians for generations to come. We all have views. Hillary Clinton's emails and Paul Manafort's friends are catnip for all of us, but let's keep that stuff out of a room that is about improving national security and conducting oversight. Second, let's go after each other's ideas in a way that improves them. Let's stay away from motives, from personalities, and from hidden agendas. I will be far more grateful to the Republican who changes my thinking with good argument and good facts than I will be with the Democrat who simply agrees with me. If you think my ideas are bad, change my mind with facts and good argument. Third, and finally, let's respect each other. For whatever else we may think of each other, a whole lot of people sent each and every one of us here to represent them. We have to respect that. Like I said, I've been here a long time. I understand why Democrats need to repeat the word QAnon and why Republicans need to call me a radical socialist. Just please, do that in a different room. The chairman doesn't have immense power, but he has discretion in determining when language becomes unbecoming. And I really would like to model something better than we've been showing these last couple of weeks. I think we have a real chance to lead here, to show that there's a better way, and so let's do it. With that, this hearing is entitled Supporting Small and Minority-Owned Businesses Through the Pandemic. I now recognize myself for 4 minutes to give an opening statement. Welcome to the first hearing of the Subcommittee on National Security, International Development, and Monetary Policy. I'm eager to delve into the subject matter under the jurisdiction, the many subject matters under the jurisdiction of this subcommittee. Our purview is broad and cuts across a range of issues important to the American people, whether it be keeping terrorists from accessing our financial system, ensuring that we're leading on the global stage through international institutions, or overseeing the Federal Reserve's efforts to rescue the economy. These issues have never been so important. I look forward to working with all of you on those issues. As I said before, I'm also just delighted to be joined by Ranking Member French Hill. I want to, as I said before, continue the history of bipartisan work on this subcommittee. The issue before us affects all Americans, and I'm confident that this subcommittee will serve as a model for what can be achieved. Today's hearing focuses on an issue that I can say for certain every member on this subcommittee has dedicated a tremendous amount of time to since the onset of the pandemic: support for small and minority-owned businesses. I see the challenges every single day in my very, very diverse district. In March, as the sheer scale of the economic challenges before us became clear, Congress acted to pass the largest stimulus bill ever, the CARES Act, to deliver the desperately needed aid across the economy. In December, we again came together to continue that support. However, as the stimulus made its way into the economy, many of us became concerned at the undeniable fact that not all communities were equal beneficiaries of that aid. In April, I co-authored an op-ed with Connecticut's treasurer, Sean Wooden, arguing that more needed to be done to ensure aid was making its way to minority-owned businesses, as well as businesses in traditionally underserved and underbanked communities. And without objection, I'll enter that op-ed into the record. In this hearing, the subcommittee will explore the successes and the failures of the systems we set up to help small and minority-owned businesses weather this pandemic. It's vital that we understand why aid to minority-owned businesses was delayed while other well-connected businesses that were hurting less made their way to the front of the line. Our efforts today are not focused on laying blame, but on helping to lay the groundwork on how we can do better going forward, because the issues we're addressing here today won't simply disappear after we defeat this virus. I'd like to thank profoundly our witnesses for being here. I'm sorry we couldn't welcome you more formally and in person, but we're going to really enjoy your testimony as we wrestle with these questions. At this point, I would like to yield to Ranking Member French Hill.
Well, thank you, Chairman Himes.
And Ranking Member, since I took more than my fair share of time up front, you will get the same discretion.
Well, I thank my friend from Connecticut, and I want to say what a treat it is to refer to Jim Himes as chairman of this subcommittee. Not that those of us on the Republican side of the aisle don't want the word chairman as a prefix to our names, but we look forward to working with you, and we appreciate the attitude that you have and the critical support you've delivered as a member of the Intelligence Committee and a longtime supporter of America's national security. This task force, as Steve Lynch will certainly report, that was turned into a subcommittee happened the year that Emmer and Zeldin and I came into the House, and I actually all 6 years have been very impressed with the original terrorism task force that's now the National Security Subcommittee on, as you pointed out, the bipartisan nature of the committee. And I want to thank the Republicans in the last Congress for being creative and collaborative with their Democratic colleagues. And we got a number of good bills out of this committee through the full committee and across the House floor that countered China's debt trap, lack of transparency in their creditor status in the third world, something that's very important to a lot of members on both sides of the aisle to shine a light on that, as well as holding them accountable in a number of ways. So I thank all my colleagues on both sides of the aisle for their work on this subcommittee.
Okay.
I also would say that Mr. Himes and I share this interest in international affairs, and we know that this committee is a major partner in America's strategy, both in sanctions, in identifying ways to cut off terror finance, collaboration with transnational crime, really around the world. And that issue has not gone away, even though the committee in the last Congress was more focused in the international finance arena and in China's emerging rival status with the United States. So again, let me echo what you said, which is encourage members on both sides of the aisle to visit with me on the best ideas you have for both hearings and legislative priorities. Today, we're discussing the state small business credit initiative, which would reintroduce a program that was created back in 2010 after the financial crisis. It's aimed at providing additional funding to assist small businesses. It seems to me that this is a similar hearing to the one this subcommittee held last summer on HR 6918, the Paycheck Recovery Act. that would require the U.S. Treasury to provide grants to small businesses. As I mentioned last summer, and it bears repeating now, these types of programs, in my view, should not be moving through this subcommittee. Instead, the House Small Business Committee should be analyzing the state of all aspects of financing for small business, including the State Small Business Credit Initiative. As a longtime supporter of small business and as someone who's previously spent a part of 4 decades starting businesses, I'm not denying the importance of ensuring that small businesses remain operational. I'm simply stating that our subcommittee could be better suited to discussing the issues squarely in our jurisdiction, such as items just mentioned by Chairman Himes and myself, threats from China, the annual oversight of CFIUS, which we're supposed to do, and even in the last Congress, we never accomplished it, and obviously the importance of monetary policy oversight, just to name a few. Instead, we're using our very limited hearing time to discuss this program. As of today, the federal government has authorized nearly $3.8 trillion in COVID-19 relief. Of that, about $1 trillion is aimed at small business relief. Specifically, the Paycheck Protection Program, the largest federal small business program with over $650 billion has been allocated, and $100 billion of which still remains, including for first-time users and second chance PPP users. I was reviewing the state small business credit program that was set up during the Obama administration. It was about $1.5 billion, and not all the funds ended up being allocated over the years of the program. It had very limited oversight and didn't seem to achieve its proposed goals from looking at the General Accountability Office's summary of this program. In my home state of Arkansas, I contacted the Arkansas Development Finance Authority, which oversaw this program. I spoke to the individuals that were responsible for implementing it and was told, and I quote, "It was not a pleasant experience," close quote. And as far as they noted to me, it did not save or create a single job during the term of them attempting to use it in my home state. As many of us know, the success of the PPP program from last year's CARES Act had kinks and faults, as any startup program with the government has. Something was created and immediately in 2 weeks began extending grant loans to small businesses. However, over the last 10 months, many of those flaws have been corrected, and businesses are receiving the benefits of the Paycheck Protection Program. So another thing I'm very cautious about today as we start this hearing is trying to initiate another program with a startup phase and changes and notice to rulemaking and frequently asked questions that would potentially complicate things and delay our small businesses' further access to funds, particularly when we have so much at the stake now that we've advanced in the EIDL loans and the Paycheck Protection loans. 2 big, well-funded, successful programs as a part of the CARES Act and are in the jurisdiction of the Small Business Committee. And with that, Mr. Chairman, I yield back and I look forward to the discussion today.
Thank you, Mr. Hill. The chair now recognizes the chairwoman of the full committee, the gentlewoman from California, for 1 minute. The chairwoman needs to unmute.
Thank you, Chairman Himes. And I wanted to be here to congratulate you on hosting your first subcommittee hearing this Congress and on such an important and urgent topic. Small and minority-owned businesses are the heart of our economy. Unfortunately, the COVID-19 pandemic has focused heavy financial and public health pressures upon them. Reviving programs like the State Small Business Credit Initiative and providing specific programs for the hardest hit businesses like restaurants are options that could provide targeted relief. This hearing must also focus our attention on minority-owned businesses whose historical challenges with accessing capital and assistance programs have been exacerbated by this pandemic. Thank you for the minute. I yield back the balance of my time.
Thank you, Chairwoman. Today, we welcome the testimony of our distinguished witnesses. In order, Ms. Nneka Brown-Massey, founder and creative director of Innovative Supplies Worldwide, Inc., on behalf of the Main Street Alliance. Gary Cunningham, president and CEO of Prosperity Now. Cliff Kellogg, executive director of CPACE Alliance. Everett Sands, the CEO of Lendistry, and Holly Wade, executive director of the National Federation of Independent Business Research Centers. Witnesses, a reminder that your oral testimony will be limited to 5 minutes. You should be able to see a timer on your screen that will indicate how much time you have left, and a chime will go off at the end of your time. I would ask that you be mindful of the timer and quickly wrap up your testimony if you hear the chime, so that we can be respectful of both the witnesses and the committee members' time. Without objection, your written statement will be made part of the record. Ms. Brown-Massey, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Chairman Hines, Ranking Member Hill, and members of the subcommittee, thank you for the opportunity to testify today on the need to better support minority-owned and smaller businesses like mine. I'm honored and humbled to speak before your esteemed panel and to be alongside my distinguished fellow witnesses. And more importantly, thank you for putting this hearing topic front and center at the start of the 117th Congress and demonstrating your strong commitment to helping the small business community. My name is Nneka Brown-Massey, and I'm the founder and CEO of Innovative Supplies Worldwide, a school supplies design-based company in Tulsa, Oklahoma. I am also speaking today as a member of Main Street Alliance, a national network of more than 30,000 small business owners who, like me, are eager to share their perspectives on critical public policy issues, especially as we try to find our way out of this once-in-a-lifetime pandemic. In July of 2016, less than 2 months after finishing my 9-year career as a human resources specialist in the United States Army, I launched Innovative Supplies Worldwide, a stationery manufacturing company. In the first 24 hours of my e-commerce launch, my brand new business had sold more than 8,000 stationery notebooks globally. I received numerous awards and was accepted into entrepreneurship programs. The future could not have looked better or brighter for my startup company. Then COVID-19 hit us all last spring, and in my case, caused consumers to shift to online classes. With the transition to remote and digital learning, demand for my physical product dipped and my sales dropped more than 60%. When relief programs opened last April, following passage of the CARES Act, I immediately applied for the EIDL Advanced Grant. However, after months of radio silence, I was finally told in June by an SBA representative that I had been denied for vague credit reasons. I was forced to establish a new relationship with a new bank. When I tried to apply for the PPP, because the bank I previously worked with closed their only branch in my town, only to be told by the new bank once I had opened my account that they would not accept new PPP applications at the time. To compound matters, I'm a service-disabled veteran with concussion complications from airborne missions held inside the United States with the 82nd Airborne Division. As a result of injuries I sustained, my executive functioning skills impact the ability to manage and process large amounts of paperwork without disability accommodations or support. The extensive and complicated loan application process required to access credit and capital became overwhelming for me. As profits dissipated and capital dried up for my struggling business, I resorted to using disability benefits from the Department of Veteran Affairs for my traumatic brain injuries and PTSD. It wasn't too long before my car was repossessed by Fifth Third Bank. With what little faith I had left, I applied for and was accepted into the Tulsa Remote Program that pays remote workers $10,000 to move to Tulsa, Oklahoma for a year. However, just to pay for the move, I had to use my tax refund and my stimulus check. What my experience underscores are the very real barriers that exist when it comes to accessing capital and credit as a person of color living in a rural area who wasn't well connected to the banking industry. I'm here today not just to share my story, but to advocate for other small business owners who could just as easily be sitting on this panel. What would have helped me the most and could still help me now is a flexible, responsive, direct grants program. Even just a $5,000 or $10,000 grant can change the course of my business and my life. In closing, I'm grateful to appear before this committee today, despite experiencing the highest of highs and the lowest of lows. At the end of the day, I'm an entrepreneur trying my hardest and doing my best to succeed. I have proudly and dutifully served my country, sought the same opportunities that others have been afforded, and done whatever necessary to achieve financial freedom, including packing my bags, moving to a foreign place, and securing my daughter's well-being by making the incredibly painful decision to send her to be with her father in another state, rather than force her to share the same sacrifices I am making. Despite the setbacks I've been dealt, I look forward to resuming the business mentorship I was providing to my employees, many of whom are at-risk youth, training them on inventory software, social media marketing, resume building, and other skill sets. Despite everything I've been through, I still believe in myself and the potential of future entrepreneurs. I hope that you and your colleagues in Congress will make the most of this uniquely challenging yet historical moment in time to speak from the past and rethink entrepreneurship in this country. There are a number of lessons from 2020 and the uneven implementation of COVID relief programs for small businesses. My experience is one data point that could be built into a more intentional and systematic effort to collect quality, disaggregated data about minority-owned small businesses. There should be a thorough examination of SBA lending, technical assistance, and other programs to assist their effectiveness of supporting very small businesses. Consumer protection should be expanded to small
Ms.
business.
Brown-Massey, your time has expired.
Thank you.
We'll have an opportunity to finish off during the period of questioning, but thank you for your testimony, Ms. Brown-Massey. And Mr. Cunningham, you are now recognized for 5 minutes to give an oral presentation of your testimony. Mr. Cunningham, I think you need to unmute. Thank you.
Ranking Member Hill, and members of the full committee, Chairwoman Waters, and thank you for inviting me here today. It's such an honor. Really appreciate it. My name is Gary Cunningham. I'm the president and CEO of Prosperity Now, a national nonprofit that creates, identifies, tests, and scales new and existing solutions that address the root causes of the racial economic injustice in America. I came to Prosperity Now after serving as the president and CEO of a community development financial institution and minority business development agency in Minnesota. Therefore, I have experience working hands-on to help entrepreneurs of color succeed. I'd like to start today by just setting the stage. According to the data from the U.S. Senate's Committee on Small Business and Entrepreneurs, over the last 10 years, minority businesses accounted for more than 50% of all new business starts in the United States and created more than 4.7 million jobs. There are more than 4 million minority-owned businesses in the United States with annual sales of close to $7 billion. That's a sizable footprint. Ensuring their financial health as employers and economic contributors, therefore, is critical. It is critical that we develop specific approaches to help minority businesses grow and scale. This will require targeted programs designed to serve those that have historically been left out. For instance, the Paycheck Protection Program, a universal program with outstanding goals, did not reach all businesses equally. Many minority business owners were left out of the process because the universal program wasn't targeted to their specific needs. For example, many minority-owned businesses do not have relationships with commercial banks and other mainstream financial institutions. We are losing economic productivity and trillions of dollars in GDP when we do not fortify the support for a strong ecosystem of minority business enterprises. In fact, Black-owned businesses were the fastest growing business segment in the country before COVID-19 hit. Between February and May of last year, however, a whopping 41% of Black-owned businesses shuttered. The impact of COVID on minority business is dire and threatens to undo the growth we've seen in the last decade. I must be clear. I am not here to argue for handouts. I'm here to argue that targeted strategic investments to minority businesses will yield significant returns in the form of increased home ownership, jobs, and tax revenue. From my experience in working with minority entrepreneurs, access to technical assistance is the secret sauce of success. Trusted guidance in the form of technical assistance is needed to grow and scale these businesses. Many need investments in infrastructures, simple things like bookkeeping and accounting support, or help filling out a loan application. The current system with MBDA and SBA is needed, but we need more. We need to increase the level of technical support and assistance and capital going to minority businesses. Despite all these barriers, entrepreneurs of color are making a difference in this country. They're at the forefront of closing the racial wealth gap. We are facing a moment of true reckoning. There's so much at stake at this moment. Giving minority businesses the tools to survive can result in stronger employment and economic outcomes, a healthier trajectory for communities across the country, and a chance to truly close the growing racial wealth gap. Closing this racial wealth gap, is not just a moral argument. It is vital to establishing a sound economic future for this country. And it could increase GDP by over $1 trillion to $1.5 trillion over the next decade. Thank you for having me and giving me the opportunity to speak today. I look forward to your questions. Thank you, Mr. Chairman.
Thank you, Mr. Cunningham. Mr. Kellogg, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Thank you, Chairman Himes. Good afternoon. My name is Cliff Kellogg. I commend the committee for holding a hearing on this important topic. I have worked on these issues in many professional capacities during my career, from South Shore Bank to City First Bank in DC. However, I believe the committee invited my testimony today due to my experience as the director of the State Small Business Credit Initiative during the Obama-Biden administration. My testimony is in two parts. First, I will highlight some of the most significant outcomes of SSBCI. Second, I will offer a few ideas on how a reauthorized SSBCI could extend its impact to create even more benefit for minority-owned businesses and disadvantaged communities. In 2010, lawmakers designed SSBCI with one overriding goal: to stimulate more private sector lending and investing. Then, as now, dire economic conditions made lenders and investors extremely cautious. Just yesterday, the Federal Reserve Banks released their small business credit survey, showing that only 13% of African American owned firms received the full amount of financing they sought, while their white owned firm peers met their financing needs more than 3 times as often. SSBCI's strategy is simple: provide states with funds to share in the risk of making loans and investments. SSBCI required at least $1 of private capital at risk for every federal dollar, with the goal of achieving 10-to-1 leverage over the life of the program. The specific outcomes were as follows. In 2010, SSBCI awarded $1.5 billion to programs in all 50 states, DC, and the territories. The result was over 21,000 new loans and investments exceeding $10 billion. On average, businesses supported by SSBCI employed 11 people, though half of the firms employed 3 people or less. Clearly, the program reached small firms. 43% of the loans or investments were located in low or moderate income communities, and 41% went to women-owned or minority-owned businesses. Again, a good sign that SSBCI reached underserved communities. So what makes SSBCI distinct? First, SSBCI gave states the flexibility to design their program to suit local conditions. States could fund startups or expansions, manufacturing loans or microloans. Some states chose to provide additional collateral. Other states funded reserve accounts for a portfolio of loans. States could operate their program directly, or they could hire a contractor. Because local conditions vary from state to state, flexibility in design made SSBCI successful. Second, SSBCI enabled lenders to make larger loans or loans on more favorable terms than they would have made otherwise. SSBCI shared in the risk, but the private sector always had the greatest skin in the game. SSBCI demonstrated that a well-run program reaches a vast range of small businesses, including underserved businesses. Again, the data from version 1 of SSBCI are promising. As the committee considers reauthorizing SSBCI with higher appropriations, it is clear the states have the capacity to scale up their SSBCI programs, and that alone will be a new benefit, a larger benefit to small businesses. However, more can be done in version 2 of SSBCI. First, states should be required to include outreach through CDFIs and minority depository institutions, and they should be authorized to collect demographic information on the businesses they serve. Second, the committee might consider increasing the amount allocated to states or run a competitive round for states, provided they reach an above average share of minority-owned firms. The committee might lower the required leverage for these high-performing states. Third, states should be asked to fund technical assistance to small businesses from their allocations to ensure equitable access and optimum use of these resources. Last, the committee might consider allowing multi-state applications, or in the alternative, running a competitive round that awards funds directly to those lenders with a multi-state footprint. A multi-state footprint is especially important for equity investment programs that target underserved communities. In summary, version 1 of SSBCI clearly supported small business economic recovery. Reauthorizing a larger SSBCI with enhancements to reach underserved communities would be a valuable part of helping small and minority-owned firms recover from this pandemic. I welcome any questions you may have. Thank you very much.
Thank you, Mr. Kellogg. Mr. Sands, you are now recognized for 5 minutes to give an oral presentation of your testimony.
Good afternoon, Chair Hines, Ranking Member Hill, and Chairwoman Waters. Thank you for your interest in my perspective on today's topic, which has been an everyday conversation for so many of us the past 10 months. My name is Everett K. Sands, and I have more than 20 years of experience in lending. For the past 5 years as founder and CEO of Lendistry, my focus has been on responsible lending to underserved small businesses, and particularly those owned by minorities, women, veterans, and people in rural areas. Lendistry is a minority-led CDFI, FinTech CDFI, a member of the Federal Home Loan Bank of San Francisco, and an SBA lender. We're signatory on the Small Business Borrowers Bill of Rights, and we also have a nonprofit technical assistance affiliate. Lendistry ranks second nationwide in SBA Community Advantage lending, which ranges from $50,000 to $250,000. Community Advantage is the only category of SBA loan in which Black and Latinx borrowers combined account for more than 10% of annual loan volume. More than 73% of Lendistry's total outstanding principal loan balance is with minorities and women-owned borrowers. Lendistry's focus on small and minority-owned businesses and our ability to efficiently process high volumes of applications have enabled us to make an impact during this period of urgent need. By the one-year anniversary of COVID lockdowns, Lendistry will have deployed nearly $1 billion to over 70,000 small businesses in PPP loans and government grants. Prior to the pandemic, Lendistry funded millions in SSBCI-backed loans. The program gave us flexibility in our underwriting criteria without sacrificing our credit and risk management. But we could have originated more and made more impact if certain barriers were lowered. Before discussing specific recommendations for the SSBCI legislation, I'd like to discuss 4 urgent objectives and opportunities for SSBCI that I believe should frame the subcommittee's work in this matter. First, SSBCI must clearly answer the urgent need among small and minority-owned businesses for capital to help them survive, stabilize, and recover through the pandemic in a way that recognizes the disparate impact of the pandemic on minorities. Second, SSBCI should be robust enough to act as an engine for inclusive national economic expansion. Whenever there are massive economic shocks, from Katrina to the Great Recession, the driving force of recovery and job creation comes from new business formation. The decisions the subcommittee and your colleagues make concerning the size and the design of the program will make a difference. There is a positive correlation between businesses that can have a significant multiplier effect on the economy and businesses that require capital. I want to emphasize inclusive expansion. Starting and owning a business is one of the most effective paths for minorities to close the wage and wealth gap, but minority-owned businesses face well-known disparities in accessing capital. The third guiding objective for the SSBCI is the opportunity to draw more responsible lenders. The program's size and features should make it so attractive to banks and community lenders that they come full force into the small end of the lending market, providing businesses with a welcome alternative to predatory lending. Finally, SSBCI should enable CDFIs to make maximum impact. As we've seen during PPP, CDFIs need efficient access to capital and to geographies, but in the original program, it was very difficult for CDFIs to be where the available funds were, leaving small businesses to suffer as a result. I'll now refer you to the section of my written testimony, Roman numeral 5, for an expanded discussion on 6 specific recommendations for the legislation. Here's a summary. Number 1, the funding level for SSBCI should be at least $10 billion. Number 2, the portion of authorized funds dedicated to minority-owned businesses should be 60%. Number 3, at least 5% of authorized funds should be dedicated to technical assistance in certain specific areas of pronounced need. Number 4, the legislation shall automatically authorize CDFIs, SBA-approved community development corporations, and business development corporations to offer SSBCI supported loans nationwide. Number 5, for every program supported by SSBCI, loans to minority-owned businesses should qualify for an additional 10% of guaranteed coverage. Finally, there should be mechanisms to rescind funds from states that fail to deploy their allocated capital expeditiously and redeploy those funds to states operating their programs effectively. To close, a robust reauthorization of SSBCI is necessary to meet the dual imperatives of stabilization and recovery and new business formation and growth. It's vital that SSBCI is large enough for both needs. I want to thank the chair and subcommittee members, and I'm happy to see Congressman Lynch on this side.
Thank you, Mr. Sands. Ms. Wade, you're now recognized for 5 minutes to give an oral presentation of your testimony.
Good afternoon, Chairman Himes, Ranking Member Hill, and distinguished members of this committee. Thank you for the opportunity to testify today in supporting small and minority-owned businesses through the pandemic. NFIB is the leading and small business advocacy association founded in 1943 as a nonprofit, nonpartisan organization. NFIB's mission is to promote and protect the rights of its members to own, operate, and grow their business. NFIB proudly represents approximately 300,000 members nationwide from every industry and sector. The NFIB Research Center promotes greater understanding of small business and the conditions that impact it. The center produces and disseminates various surveys and studies on small businesses focused on areas related to business operations and public policy effects. The Research Center has conducted a series of surveys over the last 10 months, assessing the impact that the pandemic has had on small business owners. These surveys assess economic conditions in their local area, utilization of federal and state loan and grant programs, as well as tax credits designed to help small business owners survive the crisis. From the onset of the crisis, small business owners have struggled to adjust to rapidly changing economic conditions. The initial months were particularly damaging to the small business sector, as historically large numbers of small businesses closed temporarily and permanently. Those businesses that remained open had to navigate strict business operating restrictions, dramatic shifts in consumer spending, and often leaving owners to use their own limited savings to keep their business open while trying to access funding through the Paycheck Protection Program. The PPP has been extremely popular with small business owners, with 76% of NFIB members receiving a PPP loan in 2020. However, it is not without significant complications and stress among small business owners who are desperate for immediate financial assistance. The initial challenges for many were immense. Owners were often confused on eligibility, how to calculate loan amounts, and how to spend their loan dollars to maximize forgiveness. NFIB quickly became an educating force for small business owners, trying to reach as many as possible to help them navigate the program, but also reach those populations of owners, mostly non-employers, to let them know that they too were likely eligible to participate. We also heard from small business owners struggling to find lenders to accept their PPP application. We know that many owners small banks have significantly declined in recent years, and community banks, and that became a clear issue in accessing the PPP program. The initial months were difficult, but as Paycheck Protection Program evolved and Congress allocated more money to the program and more lenders were eligible to accept applications, small business owners were generally able to access a loan. The first round of PPP were very effective in helping small employers maintain payroll, as well as paying other eligible expenses that were critical in business operations. The reopening of the PPP loan program last month appears to be operating much more smoothly. Lenders and small business owners are far more familiar with the program, and the allocation of funds were staggered at the beginning to better serve first those populations of small business owners who found the program extremely difficult to access during the initial rollout last year. Small business owners are eager to get back to business, but it will be some time before those more public-facing businesses, restaurants, retail, and many in the service sector are able to fully operate again. These small businesses will likely need additional support so that when the economy fully reopens, they are in a strong position to take advantage of returning customers and consumer spending. Small business owners have limited time and resources to find, navigate, and access targeted assistance programs often. Most small business owners are now familiar with the PPP and the SBA's Economic Injury Disaster Loans, another program that, despite its challenges, is often very effective in helping keeping small business owners afloat. I would encourage members of the committee to keep these programs front and center and focus resources on reaching out to those communities still struggling to access the programs. The PPP loan program is currently the best way to help those small business owners still negatively impacted by the pandemic. And going forward, the SBA's EIDL and 7A loan programs will be valuable resources for those needing additional financing not otherwise available to them. Thank you for having me here, and I yield back anytime. Thank you.
Thank you very much, Ms. Wade. I now recognize myself for 5 minutes for questions. And Mr. Cunningham, I want to start with you, but I'm going to invite the other witnesses to make to add on to this. The question of technical assistance has sort of permeated all of your presentations. I saw in my own district what happened with less sophisticated businesses as they were asked to approach banks and not necessarily have banking relationships. So my question, and we'll start with you, Mr. Cunningham. What would technical assistance actually look like on the ground? I mean, I remember when the PPP got rolled out, it was an absolute panic in the sense that banks were getting the guidance, 24 hours before they had to open for business. And so I'd love to have you paint a picture of what the kind of what effective technical assistance would look like.
Yes, thank you, Mr. Chairman. I'd start by saying that effective technical assistance really begins with a trusted relationship between the person or the organization providing that technical assistance and the business. And we call it trusted guidance for that reason, because many of the minority businesses don't have that kind of resource to actually buy technical assistance like many other businesses do. So by providing that technical assistance, what it looks like on the ground is, one, going through completely the financial situation of that business, looking at them from a strategic perspective of where they're trying to position their business. And it's also getting down in the nitty-gritty of what is their support structures, such as accounting, such as issues of marketing, such as their ability to actually seek new markets for their products or services. And so technical assistance experts actually help that business figure out what their current path is, restructure their loans or other financing if necessary, engage them with a banking, with a formal bank and a formal banking relationship, or a deep relationship with a CDFI or others. So it can take different forms, but it's all about starting the business off at one place and then moving them actually to a growth trajectory over time, or creating some stability for that business so that business can survive in this pandemic that we have.
And Mr. Cunningham, before I open it up to the other witnesses to opine, I'm still not 100% clear on who would actually be providing. Are we talking about people inside banks? Are we talking about SBA, SCORE? Who would actually provide that technical assistance?
Yeah, Mr. Chairman, there are several different ways that can happen. One is that the Minority Business Development Agencies has over 40 centers throughout the country that actually provide deep end technical assistance. There are also community-based organizations that are nonprofits in those communities that provide technical assistance. CDFIs provide a lot of that technical assistance. Most of the times with the larger banks and others, they don't provide those type of services. And so part of the reason that minority businesses come to alternative lenders such as Lendistry and others is because they actually have a trusted relationship, and the organization is located directly in their community. And so it creates a dynamic of, you're not going to open your books up to everybody. You're going to open it up to folks that you actually have a relationship and that are folks that are trying to change. So those are the institutions that are in community. And so it could be different in Indianapolis than it is in Minneapolis in terms of the ecosystem of supports, but they all are doing the same thing.
Thank you. Thank you, Mr. Cunningham. I've got just 60 seconds left, so let me invite the other witnesses if they have views on how we might be more effective on technical assistance to offer thoughts.
Chairman Hines, I do have one that I'd like to suggest. I know this meeting was held virtually, but I actually did travel to New York for this meeting. And when I was meeting with a masseuse therapist inside of the Tulsa airport, she said that she was unable to access the loans as well because she did not know how to classify her income as a massage therapist inside of an airport right now during these times. And so I ended up giving her, extra on top of the payments so that I can help her in some way get groceries because she's not getting the income that she wants to have right now.
Thank you, Ms. Brown-Massey. I'm pretty much out of time. The members are aware of the fact that we have an unanticipated floor vote right now, so I'm going to recognize the ranking member, Mr. Hill. Mr. San Nicolas, before I do that, you are getting the virtual gavel, so I'll recognize Mr. Hill, then you're next, and hopefully I can be back and reassume the chair. But if not, you're chair pro tempore. Thanks. And with that, I recognize the ranking member, Mr. Hill.
Well, thanks, Mr. Chairman, and what an excellent panel. I know the members are delighted to listen to these informed, knowledgeable panelists. And of course, you're talking about very good specifics on how to improve our small business lending programs, like the PPP, EIDL, the 7A program, and those are all jurisdiction of the House Small Business Committee and not this committee. But I think the discussion has been very informative. And I represent the fourth largest CDFI, depository CDFI in the country, Southern Bancorp in Central Arkansas. And they do such a great job. And I was on the CDFI advisory board during the end of Bush 43 and the beginning of the Obama administration. So I've seen the good work of CDFIs and the CDFI loan funds around the country. And I know how engaged you've been, and that's why Congress in both the CARES Act and the subsequent bills have increased the set-asides we were being discussed. Mr. Sands talked about Mr. Cunningham, 30 billion in PPP for CDFI minority banks. And then in the December bill, $12 billion direct to the CDFI funds so that they can do direct investment in low, moderate income communities. And then a $15 billion, again, set aside, if you want to use that term, for minority banks and CDFI that's in the third round of PPP. And when you look at the loans in those programs, they really are to everything from $500 up to 87% of the loans were under $150,000. So it really was a remarkable program. And I appreciate Ms. Wade talking about how many of her members benefited, and all of our members of Congress love doing business with and visiting with our NFIB members in our district. Ms. Brown-Massey, I really feel your pain. I was an entrepreneurial, very entrepreneurial person, starting businesses and helping others start theirs for over 3 decades before I came to Congress, and I really could relate to it. Your story, and Tulsa's 5 hours from Little Rock, and I urge you to move to Little Rock. We'll take better care of you than those Oklahomans. But you made a really good comment, was we need support urgently, and it can't be in loans. And of course, this program to the states can do other things besides loans, but it's effectively another loan program. And this is why we're all frustrated, everybody on this call, with how ineffectual EIDL was. It was a black box. You didn't know if you were going to get $1,000 or $10,000. You didn't know if you were going to be qualified, and you had to wait weeks. So that's been improved. But if I could wave a magic wand, we'd have a significant improvement in the EIDL program and remove it from this black box status. You know, it's designed for a hurricane. It's designed for a tornado. It's not designed for a permanent, not permanent, but a 50-state crisis like this pandemic. So do you still believe that really a PPP type loan grant program is the better approach to help you, Ms. Brown-Massey?
Ranking Member Hill, I think both at this point are needed.
Yeah.
I really am liking this idea of exploring giving extra capital to each state to deploy out to their citizens of each state is more effective. Like Holly was saying, a lot of the banks are bigger, the smaller ones have gone out, and so there's a lot of challenges in that relationship building that a lot of cities and towns have lost in this day and age, where I think that incorporating the states in some capacity in these times is very much necessary.
Well, I agree. In the technical assistance discussion, the hand-holding, the mentorship that Mr. Cunningham was addressing, this is so key. And in Little Rock, we have the Conductor, which is a Kauffman Foundation supported organization, the Small Business Center at the university, plus our chambers, plus our CDFIs use their nonprofit arms to do a lot of that mentorship. But I also saw a lot of community banks bend over backwards to help people fill forms out just to get them the help. So I agree that mentorship is very important. But again, let me thank our panelists for being here. I know we're going to have a good discussion. I too am going to go vote. So Mr. St. Nicholas, I'm going to yield back.
Thank you, Mr. Hill. And let me also begin, well, first by recognizing myself in the speaking order, but also by stating that I was very, for the record, very impressed by our subcommittee chairman's introductory statements for the committee, and share his sentiment as well on the excellence of our ranking member and his ability to contribute to the dialogue as well. I also want to open by saying, Ms. Brown-Massey, that you know, your story, your circumstances, they're not unique, but for you to be able to share them in this subcommittee is so important. And what you've gone through is what so many other Americans have gone through, and what this Congress needs to do and what it has been trying to do is to find ways to, of course, support the broad needs that are presenting themselves in this pandemic, but to now go in as we do these next rounds and figure out how we can further enhance the programs and tweak the programs to make them more effective. but I just wanted to say that your story is very, very impressive. The sacrifices you're willing to make to be a successful entrepreneur are really the story of everyday Americans here in this country. Mr. Sands, I wanted to give you an opportunity to further elaborate on what your recommendations are and how we can improve, particularly improve access to SSBCI support. And I'm interested in your perspective, that being from a lender, how we can further enhance the SSBCI program to help those borrowers out there that are coming to institutions such as yours seeking support, and what some of the roadblocks might be on the SSBCI program, or what some of the components are that we can further support financially, or with maybe some improved access points. Mr. Sands.
Thank you, Congressman. I will first say that the program, as initially designed, was designed well. And I think that one of the things we have to always recognize is that programs need to be tweaked, and we need to learn from different programs, whether it be the SSBCI or whether it be PPP or others. The first thing I think we need to concentrate on when we're thinking about an intentional focus in terms of where capital flows is the deployers of capital. One great thing which has been mentioned here is that Congress has already made the decision to invest in CDFIs, giving more money to the CDFI fund, including the recent $12 billion, HR 7933, and we thank Chairwoman Waters and other Congress professionals, men and women, for that help. Now that that resource has been invested, and prior to that resource being invested, there were already these CDFIs with this intentionality, whether it be the technical assistance that Mr. Cunningham mentioned, or whether it be the ability to actually lend to these communities. They don't actually have to build rapport. They just need to be empowered to do more. And we've been able to see this in a couple of the programs that we've run. For example, in the state of Pennsylvania, we ran a program in which 18 CDFIs collaborated. We took in 62,000 applications in 20 days for $1.1 billion in requests. That scenario, what we did, we've done through 9 other programs of having mission-based lenders collaborate together. And so I think in this SSBCI 2, what we need to do is just recognize where's the opportunity for these collaborations that, one, have already been created. You take a company like Lendistry, which has already built the technical infrastructure or the technology infrastructure. And again, the intentionality and the capital is now pouring in. So I think we've got a huge opportunity to do something fairly significant here with SSBCI version 2. Thank you.
Mr. Kellogg, please.
Representative Sands, thank you. I wanted to clarify one point that of the SSBCI funds, 1/3 was used for equity programs. So these were 2/3 were used for loan programs, 1/3 for programs that would help launch new programs or help the growth of small businesses. And that money for equity is so scarce, especially for minority-owned firms, and it is critically needed in areas that are often not thought of as the where equity capital is available. So this money for equity did not go to California, Boston area, New York City area. Instead, it went to areas like Oklahoma, Tennessee, Michigan, Wisconsin, state of Washington. So there is an important use of SSBCI for that kind of investment capital. I just wanted to bring that to the committee's attention. Thank you.
Well, thank you very much. That expires my time. I will go ahead and yield back and now recognize Mr. Williams for 5 minutes. Sir.
Thank you, Representative. Aggressive tax policy allows businesses to make money, create cash flow, and expand their operations. After we passed the Tax Cuts and Jobs Act, we saw more jobs than people, which caused businesses to compete in order to attract workers. In the auto industry, we saw car washers making as much as $18 an hour after the tax cuts went into effect. Competition in a booming economy increased workers' wages, not government mandates like a $15 minimum wage. This one-size-fits-all system might be feasible to some cities like New York or LA, but for businesses in Clifton or Coppers Cove, Texas, this additional cost would be devastating for small businesses. So, Ms. Wade, my question is, can you talk about the effects of increasing the federal minimum wage to $15 an hour?
Certainly. We just actually today released a survey on the effects of a proposed $15 minimum wage for small employers, and roughly 3/4 of them said that they would be negatively impacted if they had to comply with a $15 minimum wage increase over 5 years. And this increase of a $15 minimum wage would most negatively impact those industries that are most negatively impacted, unfortunately, by the pandemic. So those public-facing businesses in restaurant, retail, accommodations would be largely the biggest, have the most negative impact of an increase in $15 minimum wage. But it's not just the $15 minimum wage, having the wages go increase to $15 minimum wage. It is increasing everybody around that $15 minimum wage level and adjusting those compensations for experience and the technical aspects of the position. So business owners, when asked how they would absorb those costs, it would primarily go to lower earnings, but also reducing employee hours, reducing employee part-time for full-time, and not filling open positions.
Okay. Coming out of the COVID-19 pandemic, we need to make sure entrepreneurs are able to take a chance on themselves to pursue the American dream. If someone lost their job because of the pandemic and wants to try to start their own business, we've got some great examples here today. We need to do all we can to support those efforts. Our economic system is built on competition. It's built on risk and reward, and we need to be examining the barriers to entry that are preventing people from taking that leap of faith and to bet on themselves. So another question to you, Ms. Wade, can you talk about some of the barriers to entry that we should be looking to lower in order to make it easier for someone to start their own business?
Sure, absolutely. So for small business owners or small businesses or people trying to start a small business, lowering the barrier to entry is a critical component. The increased costs, not only on a federal level, but on a state and local levels, just raise the barrier of entry for many people who are wanting to start a small business. The more it costs to hire that next employee, the less likely that will happen, and the more challenging it is to navigate the regulatory system and tax compliance system in operating a business. You will find less folks likely to open and start a business. So those are the main challenges. It's a lot, but regulatory and tax compliance are two of the biggest ones.
Less regulation puts more hands in those of the people and the small business owner than the government, which gets us return on investment. So lastly, the Paycheck Protection Program was successful in quickly getting that money to business in need. By partnering with the private sector, banks and financial institutions, they were able to distribute hundreds of millions of dollars in record time. There were some flaws with the program when it was first implemented, but it seems to be running pretty good, smoother now than it has been this second time around. So, Ms. Wade, what lessons can we take from Paycheck Protection Program that we try to incorporate in other government programs to assist small business?
Using the vast structure of the banking system was key in getting the money out to small business owners. But as many of the witnesses had talked about, the relationship of small business owners to their bank was a crucial component that many small business owners lacked. And that relationship is often occurring at smaller and community banks, which have those relationship lending experiences that are important. So the decline in those type of banks, I think, is crucial in supporting that relationship.
Well, I would just close by saying the banks did a tremendous job. I don't know another country in the world that could have done what our banks did. We need to compliment them. With that in mind, Mr. Chairman, I give back my time.
Thank you, Mr. Williams. Mr. Torres, thank you, Mr. Nicholas. San Nicholas, I got back. Thank you for jumping in there. With that, I think we go to Mr. Torres of New York.
Thank you, Mr. Chair. I have a question about the performance of the Main Street Lending Program, which was run by the Federal Reserve before expiring at the end of 2020. Even though the program had $600 billion in lending capacity, it only generated $16.5 billion in loans. I'm wondering if anyone on the panel knows why the program appeared to perform so poorly.
we at NFIB, I'll just jump in here quickly. At NFIB, we surveyed to see how the understanding or just knowing about the program for the small business community. And it was largely not heard of, it was not advertised, but also the big component that was such a challenge was the 5-year loan term and having to pay that back in such a quick time frame. That's why the Economic Injury Disaster Loan Program is so helpful with that 30-year term loan. The Main Street Lending Program, it was just too difficult to navigate some of the terms in being comfortable in paying back those loans, but also even knowing that the program existed was a challenge.
Oh, that's helpful. Thank you. I have a question for Mr. Kellogg. I know the Obama administration regarded SSBCI as a success story. In partnership with the federal government, the states leveraged $1.5 billion to generate $10.7 billion in loans and investments. And it's said to have led to the creation and retention of 240,000 jobs. I know you laid out some of the reforms that could be made to the program. I'm curious to know, how would you evaluate the efficacy of the program relative to PPP? I don't know if you heard my question, Mr. Kellogg. I think you're on mute.
Thank you. I'm sorry, my connection has not been reliable, but I can hear you now.
Did you hear my question, or?
No, please, would you mind?
I was just asking if you could compare the merits of the PPP program to the merits of SSBCI. Which one do you see as more effective?
I think they're both critical. The PPP was designed to provide 2.5 months worth of payroll expense on a forgivable basis, which was critical to survival, but was never designed to be a program to help businesses grow. And the SSBCI program was designed to encourage banks and investors to make those kind of growth investments. So they serve a different policy purpose. Is that helpful?
Fair enough. I have a question about minority-owned businesses, which were hit the hardest by the pandemic. As you know, in the early months of the pandemic, 41% of Black-owned businesses, 32% of Latino-owned businesses were wiped out essentially overnight by the economic impact of COVID-19. And not only are minority-owned businesses the first to be hit the hardest, but are often the last to receive relief, as we saw with the first round of PPP. I'm wondering, should there be a program that is dedicated specifically to providing financing to minority-owned businesses? It seems to me that whenever we create a race-neutral, generally applicable program, it almost invariably leaves behind minority-owned businesses. I know there's the MBDA is a dedicated facilitator for minority-owned businesses, but I'm wondering if there should be a dedicated lender for minority-owned businesses. Any thoughts on that?
Mr. Torres, can I?
Sure, whoever has thoughts.
I have 2 thoughts.
Sorry, I was just going to jump in. I think what we have, and you've seen this through a couple of programs, PPP, Main Street, and also an SSBCI, we don't necessarily have a programmatic issue. We have a deployment of capital issue. And so we are not giving the capital to those who understand where the capital needs to be deployed. And it is structurally incorrect. And I would also tell you an unintended consequence of the $4 to $5 to $6 trillion that will end up here through our multiple stimuluses. We're about to repeat the process. We keep assuming that a bank that has excess capital is going to all of a sudden do smaller loans. It is actually contrary to the business operation. If they have more capital, they're going to do larger loans. So what we have to understand is that we have to create structures in which the larger institutions capitalize the smaller institutions, and then the smaller institutions, which are already in touch with the community, will be the ones who deploy the capital. CDFIs represent the new community bank. And so we used to be in a structure where there were 30,000 banks, and now we're in a structure with 5,000, and we're saying, well, why don't things happen the way they used to happen? Well, it's because our structure is out of line. Once we fix the structure, which is one of the things that we're recommending in the SSBCI program, is their SSBCI programs, they do banks when they fund CDFIs. Thank you for your time.
Thank you. The gentleman from Ohio, Mr. Davidson, is recognized for 5 minutes of questions.
Thank the chairman, thank the witnesses, really appreciate this hearing as a small business owner myself. This is a cycle, having survived as the owner of manufacturing companies through the '08 financial crisis. Frankly, I've appreciated watching this one vicariously. It looks like a pretty tough thing to ride through as a business owner. So for those of you that are doing it as business owners, I hope you make it the full way through it. Far too many people have lost their lives. We've lost too much freedom. And a big part of that freedom is the way to operate businesses during this cycle. So hopefully we can get back to the great economy we had around this time last year. Virtually everyone I spoke with this time last year would say the biggest barrier they had was workforce. Everything's going great. The only constraint on our growth is workforce, right skill set, availability, all those kinds of things. And I think our economy has the potential to get back to that. But it really highlights one of the most important things that isn't being highlighted in this hearing. The most important stimulus check Americans can get right now is a paycheck. We have to keep that paycheck pipeline flowing. And that is truly one of the big successes of the payroll protection plan. It's artificial. It's clearly not sustainable. And you can't replace a centrally planned, centrally distributed, government printed money from future generations backstop with a functioning market economy. So we're dealing with the limitations of that. And I think the sooner we safely reopen our country, we're going to see the market function and we're going to see paychecks happen. But I want to highlight the payroll protection plan in the 8th District of Ohio. There were just about 9,000 loans made during 2020 to small businesses in the 8th District of Ohio. We have about 730,000 people in our district, and we had over 100,000 people stay on payroll because of the payroll protection plan. Roughly 80% of those loans were for $150,000 or less. So I think it's fitting that we are highlighting small businesses. Jurisdictional highlights, as Mr. Hill has made aside, it is an incredibly substantial part of how this piece worked. And the benefit was, of course, to businesses who were able to keep that payroll function there, but it was very importantly to individuals and families who not only stayed on payroll, they kept their benefits in many of the workplaces that provide their benefits. And so when states did respond as situations permitted, sometimes with lots of criticism, but when they did open up and let people return to work, we could actually assess the real impact of the pandemic, because then people were making rational decisions based off of their risk assessment of the pandemic. They really had political risk, and in some places still have, like Ohio, political risk. You can't operate your business between 10 p.m. and 5 a.m. in Ohio, depending on the nature of your business, for example. There's large restrictions in many parts of the country, especially on hospitality. I'm thankful that in Washington, D.C., restaurants are at least able to have in-person dining again. So there have been large blackouts, and this is real political risk. So this is not a sustainable thing. So Ms. Wade, I want to highlight NFIB. This is a strong voice in the 8th District of Ohio. And so on behalf of the local folks, thanks for the work the national chapter does. And I really want to appreciate the work NFIB did to highlight the Corporate Transparency Act. So this is a new requirement, new burden on small businesses with 20 people or under to file a report with FinCEN once a year. So thanks for your work on that. And I just want to close with the time given to you to say, what other burdens have been put on small businesses that you wish that this body would pay more attention to?
Well, thank you for that. Most of the challenges that small business owners are facing right now outside of the health crisis, which is overwhelmingly the biggest issue that they're facing, are related to tax compliance and regulatory burdens. Once they are back on their feet and the economy largely reopens and consumer spending resumes, those challenges will remain. And again, on a federal, state, and local level, it is becoming increasingly difficult for small business owners to operate and devote attention to their operations instead of paperwork and paying more taxes with their earnings that they can then reinvest in their business. So those are the big challenges going forward.
Thank you. My time has expired. Thanks for the summary. Thanks to all of our witnesses, and I yield.
The gentleman from Massachusetts, Mr. Lynch, is recognized for 5 minutes.
Thank you, Mr. Chairman. And congratulations, Mr. Chairman, on your appointment, and also to my friend from Arkansas, Mr. Hill. Congratulations to both of you. I do want to associate myself with the chairman's opening statement. I think it's very important to lay that groundwork. And also, I think that the importance of the subcommittee's jurisdiction is as important as it has ever been. And I really look forward to working with all the members on the committee going forward. I do agree with French Hill. This is an exceptional panel. So my congratulations to the staff that usually puts this stuff together, both majority and minority witnesses. Ms. Brown-Massey, thank you so much for your service and for your family's service and for your example. As Mr. Nicholas pointed out, you got a great story, and you're a shining example of, of what we hope for. My friend, Mr. Sands, it's good to see you again. Mr. Sands was kind enough to testify before our FinTech task force, and he's been a wonderful example of the good work that FinTech can do in banking the unbanked. The first iteration of the CARES Act and our PP program sort of misfired, right? We didn't get to all the minority businesses that we had hoped to get to, and so after Chairwoman Waters and Subcommittee Chairwoman Vasquez had a second go at it, they were able to, I think we put $130 billion out on the extension, and that was very good. But one of the exceptions was Lendistry. So Mr. Sands, I'm wondering, it seemed like you had a very good match. A lot of the FinTech firms did not have a pre-existing relationship with the SBA. I don't know, but I got the sense that the FinTech viewed the SBA as sort of the old model, kind of stodgy, big on applications, all that stuff, and traditional data. But Lendistry was very good. You seemed to hook up right away. I mean, when we gave over $400 billion to the SBA, other people found them, right? Because they were the conduit. But you had a pre-existing relationship with the SBA, and you also had great success, much greater success than other FinTech lenders in actually getting the money out the door to minority businesses. So I'm wondering, is there something that you attribute your success to in being more successful than a lot of other people out there in the field? I just had for a while I've been thinking about that, and good to have you before the committee. So I wonder if you could help me with that.
Yes, thank you, Congressman Lynch. I think what makes Lendistry different is the fabric of our team. We are a group of bankers, similar to some of you here on the line. And so we were Fin guys who had to learn tech. And once we were enabled to learn the tech and understand the velocity by which the tech comes, that made us be able to transcend what we normally do, or what we had done in the past. The intentionality and the community aspect, that was already born in us. Myself personally, having worked at 2 African-American banks prior to going to a national bank. And then I think I would be remiss if I didn't mention that we started to partner with banks. Our first important partner was Goldman Sachs. They linked us up with their 10,000 small business. What started as a $10 million conversation matured into a $200 million conversation, and we worked together and we partnered. I would also be remiss if I didn't mention some of the CDFIs who worked with us to help us reach those communities. Thank you, Ms. Massey Brown, for your service. And we were able to reach small businesses that look like her and feel like her, and unfortunately, I wish we could have reached her. But I still think there's work to be done. And that's why I'm here today to talk about SSBCI and even SBA. We still are struggling as responsible lending institutions to be able to extend nationwide, to be able to have automatic approvals, even though we've been through a regulatory process. Lendistry has been through we have 4 regulatory bodies that oversee us, but yet still when we apply for things like SSBCI, we have to go into state by state minutia, which I respect as a former banker. I definitely believe in regulation. I definitely believe in oversight. But I also think that it is imperative and urgent that we recognize what's going on now, because if you take someone like Lendistry, we are going to end up doing $1 billion. There's an opportunity for $5 billion or $10 billion. Thank you for your time.
Yeah. Thank you, Mr. Chairman. I yield back.
Thank you, Mr. Lynch. The gentleman from Texas, Mr. Taylor, is recognized for 5 minutes.
Thank you, Mr. Chairman. Really appreciate this conversation. I think it's a really important topic. And I, just to kind of build what Mr. Lynch and you were talking about, just in terms of, why are smaller loans not getting done? I think a lot of the regulatory requirements that have been put on community banks has really squeezed them. I was the vice chairman of a community bank for 12 years. In that short 12 years, we went from 8,000 banks in the United States to 5,000 banks. And so fewer banks mean bigger banks, and bigger banks mean they're not going to do smaller loans. I want to say I really, in reading your written testimony, I'm very impressed with some of the numbers, Mr. Sansa, you're talking about what you're able to do in terms of doing smaller loans. And so to that, could you sort of go into some of the more technical aspects of what you were able to do with fintech to be able to do smaller loans? Because that's something that I know at my bank, we wanted to do smaller loans. We just couldn't figure out how to underwrite and manage those loans that were smaller and really have it make sense. The margin wasn't really there to support that. So what have you done, and how did fintech help you do it?
Yeah, so I think it's a two-part process. The first part is the partnerships and the collaboration on the ground. As a banker, old school, we would do loan production offices. New school is you leverage tech. The second thing, and so I'll give you an example of that. In the state of California, we're doing a $500 million grant program. In 15 days, we took in 344,000 applications, successful applications. We have 35 partners. We have 400 core partners. All of them are mission-based.
Are you chartering branches in California to do that?
We have 2 locations in California, but we have 500. And then this will get to the tech part. What is important, as you hear from Ms. Massey Brown, is that it's very important that we make sure, Brown-Massey, forgive me, we make sure that we give the user a seamless experience, that we give them a similar experience, right? So if we create multiple different types of applications, multiple different processes, this is where it gets clunky. And these are the things that we need to work on. And this is what we've learned that tech enables us to do. So when you add collaboration plus tech, it creates seamless user experience. Then we have to work on scalability. And scalability is about the partnerships, and it's about intentionality of what we're focused on. And what we've been able to do here at Lendistry is we've been able to say, it doesn't matter where we're at. So if you take California, we speak in 30 different languages. We've got webinars in 18 different languages. It doesn't matter whether it's rural. It doesn't matter whether it's Black, white, Asian. It doesn't matter because, again, you're leveraging tech, you're leveraging marketing automation, and you're leveraging partnerships in order to meet your need. And that's what we've learned how to do.
Are you underwriting in an automated fashion, or are you using AI to underwrite so that you can expedite that component of what you're doing?
Yeah, it depends on the loan size, right? And so the best way I would say is that what tech allows us to do is tech allows us to create filters and allows us to concentrate on where the underwriting should be spent. I think that's the most important thing, right? Because what we learned from the tech side is that you could have scalable infrastructure in terms of sales leads. What we learned from the tech side is that you can have a comprehensive approach to credit. And what I mean by comprehensive approach is you have to treat a service business different than you treat a restaurant business, different than you treat a real estate transaction. But if you can create alignment inside of your banking unit, as you know, and generally in bank, it's an underwriting unit that's kind of A to Z to know everything, as opposed to somewhat of a streamlined process where they become experts, whether it be an SBA loan, whether it be an SSBCI loan or others. So the answer to your question is we leverage the tech to filter. We still are bankers, hopefully not too old and stodgy as sometimes we call ourselves, but we still want to have that manual touch. What we do is we filter the loan and the information before we get to that manual touch.
Are you using credit scores in order to filter? Is that part of your underwriting process?
That is part of our underwriting. We have about 74 different points. Again, we're community oriented, so we have no problems picking up the phone and walking through things with a client. But there are certain level of clients that don't need that. They just want to get a loan. They just, again, we've talked about banks and banks getting larger. Operational efficiency wise, loan sizes become a big issue for banks. And so sometimes
So if I were to get rid of credit scores, would that be deleterious to your ability to lend? Does that mess up your AI algorithm to figure out who's creditworthy?
I think you always want to have the data points of lending, especially when we're talking about small businesses. We have to remember when you get to sole proprietors, they're closer to consumer loans than they are to commercial loans. So I think the credit report always plays a role.
Thank you. Mr. Chairman, I yield back.
The gentleman yields. The gentleman from Massachusetts, Mr. Auchincloss, is recognized for 5 minutes.
Thank you all for joining us today. I agree with my colleagues. It's a very impressive and informative panel. My district is in Massachusetts, and the southeastern portion of it on the border with Rhode Island has been particularly hard hit by the pandemic. It's just an hour outside of Boston, and the region is ripe for economic development and especially in life sciences, manufacturing, everything from medical gowns to biologics. Those would lead to good paying jobs, but also to the public health resilience that we need in the face of this pandemic and for future pandemics. Technical assistance is obviously much needed, but so is a lack of capital to help this region, a post-industrial region, really seize on this economic development opportunity. And so this question is for both Mr. Kellogg and for Mr. Sands. Based on your experiences with Lendistry and with the state small business credit initiative, how can we better incent capital formation really far upstream in terms of creating bio-ready sites and in terms of giving the capital structure that would-be entrepreneurs need to become manufacturers in the life sciences space?
Do you want to take that, Everett?
Yeah, sure. I think the first thing, Congressman, that we want to always look at is creating structure means creating a path to success when you're talking about small business ownership. And so I think the structure, again, relates to the deployers of capital, where I think CDFIs and mission-based organizations play a role is in what I would call the startup to the small to medium size. Then that business should graduate. As Mr. Cunningham mentioned, intertwined in that graduation is technical assistance, is business advising, is a certain amount of support, but that business should then graduate into a more structured approach. I don't think necessarily the industry matters, because I think industry experts are really part of the technical assistance. And truthfully, no one knows better than the business owner when it comes to their industry. As bankers, we would like to think that we know things, but we don't know the metrics as well as the business owner. What we want to do is just create a structure for that, for the path of success as it relates to capital as they grow that business.
My comments would focus first on physical infrastructure and secondly on human infrastructure. And physical infrastructure, obviously, there's a lot of conversation nationwide about the state of our infrastructure of all types, and that's critical to making a location an attractive place to do business. And then the human infrastructure, I think, centers around our educational institutions, and by that I am including universities, but also our community colleges, and the human infrastructure for entrepreneurship includes very much an ecosystem of investors, angel investors, successful entrepreneurs, and mentors as well. So both of those are precursors, I think, to the getting the maximum potential out of a region. I hope that's responsive.
It is, and I'm proud to say that Massachusetts has many of those ingredients you just mentioned. We've got reasonably good housing stock in the South Coast, relatively good transportation infrastructure, although not good enough, and certainly a tremendous amount of talent, both in Greater Boston and in Southeastern Massachusetts. Is there a role that you see the federal government playing in the provision of low interest loans or in grants to help people with a process that at the beginning is high risk because it involves both permitting, if you're talking about bio-ready sites, for example, as well as being able to attract the right kind of investor and developer?
Yeah, I think, and forgive me, Mr. Kellogg, if I'm over speaking here, but I think this is one of the uniqueness that the SSBCI program did, is that it allowed states to determine what was important to them and then build capital programs accordingly. So, for example, Michigan was focusing on manufacturing and a couple other things, which is obvious because of the auto industry at the time that SSBCI first came out. So I think absolutely on a state level, you could decide, what are the industries you would like to see some significant capital investment and benefit from that.
That's exactly right. As I said in my testimony, local conditions create different capital gaps, and local conditions create different opportunities to use the credit and capital market systems that exist there. That's the value of a flexible state-by-state decision-making.
Gentleman yields back. The gentleman from Texas, Mr. Green, is recognized for 5 minutes.
Thank you ever so much, Mr. Chairman. And many times, Mr. Chairman, these words of gratitude and thanks are stated in a perfunctory fashion. I say this sincerely, not perfunctorily. And I say so because I think this is a very meaningful hearing, and I think that it can cause us to give thought to how we can correct some of the things that we should have corrected years, decades, perhaps even longer ago. So I thank you for the hearing. I also want to thank Chairwoman Waters because she has been a champion in this area for years, since I have known her, and I knew her before I came to Congress. This has been something that has been of importance to her. And I'm grateful that she has you at the helm, and I thank Mr. Hill as well. He and I have collaborated on issues in the past, and I trust that we'll be able to continue our collaboration. I'd like to talk to you for just a moment, if I may, about something of importance, and it is the Minority Business Development Administration. A little bit of history. In 1969, President Nixon, by way of an executive order, created an Office of Minority Business Enterprise. Later on, President Carter renamed it to the Minority Business Development Agency. This agency, as it were, is devoted exclusively to the growth and expansion of minority business enterprise by providing technical assistance, managerial expertise, support, and resources. And this is all for minority-owned businesses. Given that it was created by executive order, it continues to survive from president to president. In the CARES Act, we appropriated approximately $10 million, not nearly enough, but it was something, and that was of good benefit because at least we continued it. $10 million to this agency, which allowed minority chambers of commerce to give grants to provide outreach and technical assistance to its members. Last Congress, I introduced H.R. 6869, the Minority Business Resiliency Act. I did this, and I wish I could say that I developed and synthesized this myself. It was because of the Honorable Maxine Waters and the staff that I was allowed to have this as a piece of legislation to go forward with. In the CARES Act, we had $25 million for minority business development with the agency. And now what we'd like to do is permanently codify this minority business development into an administration and have it as an independent agency that would be tasked with and be the only one with this unique task of satiating and satisfying the needs of minority-owned businesses. I think it's time for us to give serious consideration to this. And for this reason, I'd like to ask all of the witnesses, if I may, to tell me whether you think there is a need for an agency with this mission that can be of benefit to you for a good many things that you've talked about today. So I'll start with Ms. Brown-Massey. Thank you for your service. I appreciate much of what you said about having some difficulties accessing the system in an appropriate way. But with that said, ma'am, would you give your comments on possibility of this agency being codified, made permanent, so that we can help minority-owned businesses in this unique way?
Yes, Congressman, thank you. I do think that this particular agency that you're mentioning is of use, but I also think that we should be looking for local communities to set up minority chambers of commerces so that they're able to better understand what their community needs are at the local level. So yes, I do agree.
Thank you very much. Mr. Cunningham, if you would, please.
Yes, briefly, absolutely. The Minority Business Development Agency has a group of 40 organizations that are located in cities and rural places throughout the country. It would be fantastic if we could actually knit together a permanent agency for the MBDA. The future of American small businesses actually are minority businesses. And so if we concentrate on that, we will help everyone in this country. Thank you.
The gentleman's time having expired, we will bring this hearing to a close. I'd like to profusely thank all our witnesses for their testimony today. It was a very interesting and very timely conversation that we had. And we really appreciate your preparation and participation. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. Without objection, the following is entered into the record: a letter from the Small Business Majority, a joint letter from the U.S. Black Chambers, U.S. Hispanic Chamber of Commerce, and National ACE, a letter from Brookings Institution Metropolitan Policy Program, the annual report for fiscal year 2020 from the SEC's Office of the Advocate of Small Business Capital Formation, and a letter from the Center for Indian Country Development at the Federal Reserve Bank of Minneapolis. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I remind members that written questions and materials for the record should be submitted to FSC documents at mail.house.gov. Again, with a big thank you to our witnesses, this hearing is adjourned.